Alrighty, well, welcome to the Constructive House channel, where we simplify mortgages and make mortgages easy. All right, today we'll be going over the Mortgage Word Guide, which is an installment from my ebook series, Brick by Brick, the Ultimate Mortgage Playbook. And the Mortgage Word Guide is to make mortgage terms simple and put it on a level that's easy for all to understand. So I'm sure you've heard content creators, realtors, and mortgage professionals use terms and company jargon that may at times fly over your head. But this word guide is here to make things simple for you so you can understand and be an informed borrower and informed consumer when you're going through your home ownership or refinance journey. So I do hope that this is constructive, as this is the Constructive House channel, and it does help simplify things a bit. The Mortgage Word Guide installment is actually available on Amazon.com for just $5. And I do believe it is a very valuable tool to help simplify things, as well as the other series content for the Ultimate Mortgage Playbook. So feel free to give it a download. Like I said, it's just $5. I'll leave the link in the comment section so you can take a look at it, as well as the other books in the series. All right, so balloon mortgage. I'm sure some of you may have heard this, but you may be unfamiliar with what a balloon mortgage is. But it's a loan where you make small payments for a specified amount of time. Once that time has run out, then you have to pay the remaining loan amount. So it's like a balloon, and you're breathing small breaths of air into it all the way until it bursts. That's why it's called a balloon mortgage. Typically, the payments are interest only. That's why it's a small amount. So you pay a little amount for like 10 years. I'm just giving an example. It is different bank to bank, but typically 10 years, you make a small amount. And then once that 10-year term is over, you will pay the remaining loan amount. And you can either pay that through your own funds, or you will have to do what's called a refinance, where you'll be taking out a new loan to pay off that loan. It's not a loan that's for everyone, but there are some buyers where it is a benefit to. So, as always, I encourage you to speak with a mortgage professional to determine if that's going to be the best fit option for your situation. But keep in mind, with a balloon mortgage, it does burst and you have to pay the full remaining loan amount at the end. And if it's interest only, which most are, your loan amount would not have changed throughout that entire time that you've been making those small payments. But the benefit is you pay a smaller monthly payment and you are able to live in the house with a low payment amount. The other side of it is it can be overwhelming as far as to make that payment in full. You will have to go through the refinance qualification process if you are looking to refinance to pay off that remaining amount. And your payment will more than likely increase throughout that process of paying it off, because you did get the benefit of the small installments throughout that fixed time. So keep that in mind. A balloon mortgage, you're making small payments. Once the initial term is expired, you have to pay the full entire amount of the loan due. Simple enough. All right, borrower. Sounds easy enough. A borrower is someone who is borrowing funds or taking a loan out to purchase a home. When it pertains to mortgages, a borrower is someone who is borrowing money to purchase the house or borrowing money to refinance the house. So think of it as someone who asked to use something that belongs to someone else, and they make a promise to pay it back. That's what a borrower is. You're going to promise the bank, hey, Tim's Mortgage Hut, I want to buy this house for $500. I don't want to use my $500 that I have in the bank. So can I get a loan from you all and make small payments to buy that $500, $500,000 home that I like? The bank will go through the approval process and say, yes, borrower, I'll allow you to borrow this for this amount of interest, which is a fee you'll pay me, and then you can have this home as long as you qualify and you show that you have the ability to repay what you are borrowing. So a borrower is a person who asks a bank or a lender for money to buy the house. Simple enough. And you'll hear me refer to borrower a lot of times throughout this series, because if you're looking to buy a home and you're going to get a mortgage loan to do it, then you are borrowing the money. So always remember, you're borrowing from the bank. So that's why they have the strict guidelines, because you are borrowing money from them to buy the house. So a borrower is just a person who asks a bank or mortgage company for money to buy a home or refinance a home. Because when you're refinancing, you are replacing your old loan. So you're borrowing again, you're reborrowing, to be honest. All right. Alrighty, cash out refinance. I'm sure many of you have heard about this. As we spoke about earlier, when you have equity or ownership in your home, you do have options with that asset because that's ownership. And a cash out refinance is when you borrow more money than you owe on the house. So, say I want to do some renovations, say I want to get a pool, say I want to invest in another home, so I want a down payment. If I have equity, which again is ownership in the home, I can take cash out of that equity. I can cash it out for those purposes. Now, in order to take cash out, you will need equity, because what you'll be doing is replacing your old loan with a new loan that is more than what the previous loan was. So, in order to take cash out, you're going to need well over 20% equity in the home in most cases. So, that allows you to do renovations. So, you want to get, like I said, a pool. Maybe you want to add another car in the so you want to expand your driveway. Say you want to get another garage put on. Say you just want to improve the roof or whatever those home improvements may be. Or like I said, you may want to actually make a down payment on an investment home. If you have enough ownership, aka equity, a cash out refinance may be the way to go. As always, you want to consult with your mortgage professional to determine one, your qualifications, as well as if this is the best fit option for your financial situation. But a cash out refinance is simply a new loan that you're taking out more than what your old loan was, and you're using the equity, the ownership in your home to do it. Simple enough. If you have any questions, feel free to drop them in the comment section below. But that's all a cash out refinance is, just cashing out on the equity you have in your home. Keep in mind, though, you do need to go through the mortgage qualification steps in order to get said equity. Just having the ownership value is not enough. You still need to be approved on income, property, assets, and credit in order to get that. All right, closing. I'm sure many of you have heard of it. I'm sure you've seen on social media your friends got a big old picture and some keys. I just bought a home and they're at the closing table. That's where they're at. It's a special event when you become the official home owner. That's what a closing is. It's where you sign all the documents to finalize the deal. That's why it's called closing. You may also hear settlement, but that's all it is. That's when you're finalizing the deal. That's when you've gone through the wood, you got to the light at the end of the tunnel, and it's time to transfer over those keys and transfer over that deed in my name. That's the closing process. So that's when everything is a breath of fresh air, or it should be. You know, I've had my fair share of some shaky closings where people all of a sudden forgot what all the paperwork was at the beginning, and now they're confused. But closing, that's a great event. That's where you see your friends and whomever, family members, they get those keys in their hand and they're taking pictures. That's closing. They close, they finalize the deal. It's a special event where you have become the home owner. It's where you sign your finalized paperwork to transfer that ownership in your name. Same goes with a refinance, because like I said before, you're refinancing, you're reborrowing. So you're getting a new loan. So you have to do another closing, just as if you were buying a home again. So simple enough. That's all a closing is. Nothing special. I'm sure you get calls from your bank saying, hey, the closing agent will be calling you, yada, yada, yada. But that's all a closing is. All right, a closing agent, simply put, is a organizer who helps you wrap up all the closing documents. They organize the documents. Some states where an attorney does the closing, it'll be an attorney. Other states, it'll be considered just a closing agent or a settlement agent. But those are the ones who are wrapping up and organizing all your closing paperwork for you to sign. And they'll be the ones helping you go through the final signing of the loan. That way you're transferring that ownership back to yourself. But that's the closing agent. If you have any questions about your numbers on the loan, you need to be speaking with your loan officer, which we'll get into that, or mortgage broker. But the closing agent will go over anything dealing with the closing of the loan, the scheduling of the time, where you guys will meet. Um, if you have the official copies, and they'll make sure you have the draft of the copy, and they'll also make sure you have the final one. And you want to make sure all those numbers match up that you spoke with your mortgage banker about, mortgage professional about. But the closing agent, simple enough, is the person who organizes the closing. All right, closing cost. Closing costs are the additional fees you pay when you're finalizing your home purchase or refinance. So I know a lot of times when I talk about down payment with my borrowers and my clients, they only think of what they're paying out of pocket. But you have a down payment, and then you also have additional fees called a closing cost. That's the cost that it takes to close out the mortgage process. So everyone involved does has to get paid. They have to get paid, and that's what a lot of those closing costs are going towards. So those are additional fees you have to pay in addition to your down payment, in addition to your appraisal. Those are closing costs. It includes your prepaids. It includes any discount points. It will include any sort of fees to the title company, any sort of fees to anything that it takes to finalize and close the mortgage process. You will get a document, you'll get several documents throughout the process that detail what your closing costs are. Keep in mind, those costs are not finalized until we are getting to the closing table. All right. So make sure whatever you see up front, if that's what you're good with, make sure it does match when you get your drafted closing disclosures. Okay. But those are just additional fees you pay to close the loan. And what's it in addition to? It's in addition to your appraisal, your inspection costs. It's in addition to your down payment. It is separate out of pocket expense from those options. So keep that in mind. I hope this is making things simple for you. As I mentioned before, don't hesitate to download the Mortgage Word Guide. It's available on Amazon.com. Thank you for checking out today's video. Please like, share, and subscribe to the Constructive House channel, where we simplify mortgages and we try to make mortgage easy again.